First, I wanted to introduce myself to those of you that I have not met. My name is Megan Horneman, and I am the new Director of Portfolio Strategy here at Verdence Capital Advisors. And when I started 6 months ago, Leo and I discussed the idea behind releasing a quarterly white paper. And the idea behind the white paper was to pick a pertinent topic that we could help to educate and advise investors on how to position their portfolios. You may have read some of our other pieces that we have released. We did one on the Tax Cuts and Job Act. We did one on Bitcoins and bubbles. And we also did one on controlling emotions in an algorithmic world. This time around, we thought what we would do is include a video commentary similar to Leo's market commentary that we do on a quarterly basis. This white paper is called Inflation Inflection Point. And for some Americans, the term inflation really makes your skin crawl. And then there's other Americans that they don't really know what inflation means. There's a significant part of the millennial generation that has grown up during a period where they have seen a declining rate of inflation. But then there's another part of American society that remembers when food was rationed. Or there were those that sat in the long lines at gas stations, and the days they were able to get gas were dictated by the ending number on your license plate. So no matter what inflation means to you, it will always have an impact on your portfolio, and it is important to know how you're positioned in order to mitigate some of those negative effects in inflation. This white paper we're going to break down into 3 different segments. The first one is the current inflation environment. The second is how this time is different than prior inflation environments. And then lastly, how to position your portfolio in the current inflation environment. First, let's start with the current inflation environment. The current inflation environment has been relatively muted, and that's been because of several reasons. First of all, if you look at the economic recovery, especially at this time in the economic expansion, it has been very slow. This has not given companies the luxury to be able to raise prices, so inflation as a whole remains muted. The unemployment rate, even though it's at the lowest level in about 18 years, there still is slack in the employment market. You can see that by the labor force participation rate that is near the lowest level since the 1970s. Also, there's structural changes in the economy. If you look at things like technology, disruptors that have been able to keep a lid on prices, or the sharing economy. And when we talk about the sharing economy, we're talking about things like Airbnb or Uber. This has helped to keep prices down across the board. And then globalization continues to play a factor because of the cheap labor dynamics across the globe. Now, not all inflation is created equal either. There are some segments of the economy that have seen inflation come down drastically since the end of the Great Recession. If you look at things in this chart like televisions, computers, cell phones, they've fallen significantly since the end of the Great Recession. However, if you look at things like college tuition, or childcare, or doctor visits, these things are up well into the double digits. And these are some of the things that investors spend a significant amount of their disposable income on. Whether it's wages rising, commodity prices rising, or the massive fiscal stimulus that we're about to encounter in the coming years, investors need to be aware that we are in an inflection point for inflation. And the one thing that we would highlight, though, is that this more normal type of inflation environment is not necessarily something that should be feared. As long as inflation is rising for the right reasons, where it's better economic growth, that should translate into better economic earnings, and that should translate into higher equity prices, as well as higher wages for the consumer. Now, we do think that this time is different, though, from past times of hyperinflation or the great inflation period of the 70s and 80s for several reasons. First of all, as you can see in the chart that we show here, the Fed has many tools in its tool shed. If you look at the real Fed funds rate, it still is historically low. We're basically at 0. So if inflation did get away from us, we have the ability to raise rates. Now, currency devaluation has also led to inflation in the past. We saw this when we abandoned the gold standard in the early 70s. That led to a devaluation in the dollar and a strong uptick in inflation. Another thing that has led to runaway inflation has been a war or depression. These are things that we don't think and we don't see on the horizon. What happens in a period of war or depression is you get very irresponsible monetary and fiscal stimulus. That's not something that we foresee in the future. Policy error is another thing that can lead to runaway inflation. And a lot of people try and draw parallels between the quantitative easing program that the Federal Reserve has done in the past few years with actual money printing. But it's not really printing money where money's falling from the sky. What the Federal Reserve is doing is they are buying bonds from these banks, and then they are crediting the bank account at the Federal Reserve. So if the banks want to come and take the money to loan it out to the economy, and if they all did that at one time, that could lead to inflation pressures. However, if you look at the chart that we put up here, you don't see a significant amount of demand for loans. And that's actually coming lower and lower. We don't think that that's going to pick up significantly because we do think that we are in some of the later stages in the economic cycle. And typically banks don't see a significant amount of loan demand when you're at this point in the economic cycle. So the last portion of this white paper is really to describe how to position your investment portfolio so that you can mitigate the negative impacts of inflation. There are some do's and don'ts when it comes to inflation. The first thing not to do is to get overly aggressive with bond exposure. Fixed income investments and inflation are like oil and water because bonds pay a fixed coupon. So as inflation rises, it's reducing that value of that coupon payment. The other thing is that a lot of people talk about TIPS, or Treasury Inflation Protected Securities, as a way to hedge your portfolio against inflation. However, we would not recommend TIPS at this time because TIPS actually carry a real rate of return as well. That real rate of return is subject to interest rate sensitivity. And because we are near historic lows, as that rises, it does reduce that price appreciation. Equities. Traditionally, equities have been a good inflation hedge, and that's because equities should be able to keep pace with inflation because as prices are rising, that should translate into better corporate earnings. However, at this stage of the economic and also this bull market, we would caution investors that active management is very important to find those companies that can not only keep up with the economy at this stage of the economic cycle, but can also translate into giving that money back to consumers so that the real rate of return keeps up with inflation. And then lastly, and most specifically, is real assets. Real assets are tangible and physical. So these are things like commodities, infrastructure, land, timber. And if you look at the chart that we show, it shows that if you were to add a little bit of real assets into your overall asset allocation, that this would outperform not only a bond portfolio, but also a blended portfolio of just simply the plain vanilla stocks and bonds. The other thing about real assets is that they are uncorrelated to traditional asset classes, so it gives you an added layer of diversification as well in your portfolio. With that being said, that was a very brief overview of our second quarter white paper. If you would like to read the more detailed version, that is on our market commentary portion of our webpage. And again, if you have any feedback or questions at all, please feel free to contact your financial advisor. Thank you very much.